The IRS is preparing to take a piece of your Social Security lump sum payment. You have 13 days left to act. Congress enacted legislation to return the Social Security benefits that were rightfully yours, money that had been withheld from you over the course of several decades. Around 3.1 million retired educators, firefighters, law enforcement officers, and government workers received one-time retroactive checks in 2025, with the average payout landing at roughly $6,100 per recipient. That adds up to $17 billion altogether. Funds the federal government owed you finally delivered, and now the IRS wants its share, not because you did anything wrong, not because you exploited any loophole, but because of a timing regulation that transforms a long overdue correction into what appears on paper as a sudden income surge in a single calendar year. And that sudden surge is on the verge of pushing millions of retired Americans into tax brackets they have never encountered before, triggering taxation on Social Security income that had never been taxed previously, and in certain cases, driving up Medicare premiums for the following 12 months. The cut-off date for addressing this is April 15th. That is 13 days from right now. The IRS will not be reaching out to walk you through any of this, but I will. And before this video ends, you are going to know exactly what steps to take. This video is intended for educational purposes only and does not constitute tax or financial advice. Please consult a licensed tax professional before acting on anything related to your specific circumstances. Now let me bring you back to where all of this began, because without understanding the history, you will not be able to recognize the trap that has been set. For more than 4 decades, 2 separate provisions embedded within the Social Security system worked against public sector employees. The windfall elimination provision, commonly referred to as WAP, and the government pension offset, known as GPO. If your career was in a field that did not contribute to Social Security, such as teaching in particular states, working as a firefighter, or serving within a federal agency under the legacy civil service retirement system, these 2 provisions cut down or outright eliminated your Social Security benefits. This was true even if you had paid into Social Security at other employers over the years, even if your spouse had built up full benefits that you should have been able to claim as a surviving partner. The numbers were unforgiving. Certain retirees saw their monthly income reduced by hundreds of dollars. Others had their entire benefit wiped away. Widows and widowers of public employees who had been counting on survivor benefits were left with absolutely nothing. More than 3.2 million Americans were directly affected. They pushed for change over the course of many decades. On January 5th, 2025, Congress finally gave them what they had been asking for by passing the Social Security Fairness Act. The legislation abolished WEP and GPO in their entirety and applied the correction retroactively, going back to January 2024. That meant every qualifying retiree was owed back payments for every single month from January 2024 forward, covering the period when their benefits should have been calculated at the higher amount. The Social Security Administration responded quickly. By July 2025, over 3.1 million payments had been issued, totaling $17 billion in distributed funds. The average retroactive lump sum payment came to approximately $6,110. Some individuals received more, others received less. But for the millions of retirees who had been short-changed for years upon years, it felt like a form of overdue justice. Here is exactly where the trap snaps shut. Under the current rules established by the IRS, Social Security benefits, including any retroactive payments, are taxable in the year that payment is actually received, not the year in which those benefits were originally earned, not distributed across the years they should have been issued, taxed entirely within the single calendar year the check was deposited. That means if you received a $6,810 lump sum during 2025, the IRS counts that as $6,710 in additional Social Security income for tax year 2025. It lands directly on your return right now, the one that is due on April 15th. And for the majority of retirees, that income spike does not simply add a little more to what you owe. It sets off a chain reaction. Let me walk you through exactly how that plays out. I want to take you through 4 real-life scenarios so you can see the actual numbers at work. Scenario 1 involves a retired teacher in Ohio. She is 68 years old. She brings in $22,000 annually from Social Security and $18,000 from her state pension. Her provisional income, which is calculated by adding her adjusted gross income, any tax-exempt interest, and one half of her Social Security benefits, was sitting at around $31,000. That placed her within the 50% zone, meaning half of her Social Security income was subject to federal taxes. Not ideal, but something she could manage. Then the retroactive lump sum arrived, $7,200 in back benefits. Half of that amount, $3,600, gets factored into her provisional income calculation. Her provisional income climbs from $31,000 to $34,600. She has now crossed over the $34,000 threshold. At that point, up to 85% of her Social Security income becomes taxable, not 50%, but 85%. The difference in what she owes comes out to somewhere between $2,000 and $3,000 in additional federal taxes. All of it on money that Congress acknowledged was owed to her, money she had probably already used to cover medical expenses and put food on the table. No one ever warned her this was coming. Scenario 2 follows a retired firefighter couple living in California. Both spouses spent their careers in public safety. Both were impacted by WEP. Their combined lump sum came to $14,000. They file their taxes jointly. The income jump does not merely push a larger portion of their Social Security into the 85% taxable range. It also pushes their modified, adjusted gross income over the IRMRA threshold. IRMA stands for Income-Related Monthly Adjustment Amount. It is a surcharge the federal government attaches to your Medicare Part B and Part D premiums when your annual income exceeds specific levels. The surcharge is calculated based on your tax return from 2 years earlier. That $14,000 lump sum received during 2025 will have a direct effect on their Medicare premium costs in 2027. They could end up paying an additional $70 to $240 per month per person in Medicare surcharges for 12 consecutive months, not because their underlying financial reality changed in any meaningful way, but because a single one-time retroactive payment caused 1 year of income to appear inflated on paper. They are being penalized financially for receiving money they were already owed. Scenario 3 centers on a 72-year-old widow. Her husband was employed by a state agency. Following his passing, she applied for the survivor benefits she expected to receive. Under the prior GPO rules, those benefits had been completely eliminated. She received nothing at all. The Social Security Fairness Act restored her survivor benefit and issued her a retroactive lump sum to cover back payments. But she files as a single taxpayer. The income thresholds that apply to single filers are considerably lower. The 50% taxation zone begins at $25,000 and the 85% zone begins at $34,000. The lump sum pushed her past both of those thresholds in the very same tax year. She went from having zero Social Security income subject to taxes to having 85% of it taxable, all in one filing cycle. She is simultaneously grieving, adjusting to a new filing status as an individual, contending with the financial penalty that often accompanies the transition from joint to single filing, and now staring at an unexpected tax bill that nobody at the Social Security Administration thought to mention when they mailed her that check. Scenario 4 is about a retired police officer who had already submitted his tax return. He filed back in February using a standard tax preparation service. He noticed his refund was smaller than he had anticipated, settled his bill, and considered the matter closed. He had never heard of the lump sum election. He was not aware of the $6,000 senior bonus deduction. As a result, he left somewhere between $2,500 and $4,000 on the table. I will explain both of those options in just a moment, because they are the two instruments that can actually correct this situation. But first, I want you to fully grasp what the widespread error is, because nearly everyone is falling into it. The mistake is filing your 2025 tax return the conventional way, noticing that your tax bill is higher than you expected, assuming that is simply the way things are, paying it and walking away, all without ever learning that the tax code gives you a mechanism to recalculate how that lump sum payment is reported, and without knowing that Congress quietly created an entirely new deduction for seniors that most tax software is not automatically applying. If you received a retroactive payment under the Social Security Fairness Act, and you filed without taking advantage of these two tools, there is a strong probability you overpaid, and importantly, you have 3 full years to correct it. Let me start with the first tool. It is called the lump sum election. The IRS provides you with a choice regarding how you report a lump sum Social Security payment. There are 2 available paths. The first option is to count the complete lump sum as income in the year you received it. This is the default setting. It is what happens automatically when you or your tax preparer do not take any special steps. The entire payment shows up on your 2025 return and inflates your provisional income accordingly. The second option is to apply the lump sum election. This allows you to go back and recalculate how much of your Social Security benefits would have been taxable the previous year, meaning 2024, as though the retroactive benefits had actually been paid out at the time they were supposed to be. You determine what portion of those benefits would have been taxable under 2024 conditions, subtract that from the current year figure, and report only the remaining difference on your 2025 return. The instructions for this process are laid out in IRS Publication 915. You compare the tax result under both approaches and apply whichever one produces the smaller tax obligation. There is no need to submit an amended return for 2024. The entire recalculation is handled directly on your 2025 return. For a large number of retirees, particularly those whose lump sum nudged them across a provisional income threshold, the lump sum election has the potential to save hundreds or even thousands of dollars. It can mean the difference between 50% of your benefits being taxable and 85%. Ask your tax preparer this specific question. Did you run the lump sum election calculation for my Social Security Fairness Act payment? If they look at you with uncertainty, find a professional who knows what you are talking about. Now for the second tool, this one is brand new, and it is the reason every senior watching this video needs to pay careful attention. The One Big Beautiful Bill signed into law on July 4th, 2025, introduced a new deduction created specifically for taxpayers aged 65 and older. It amounts to $6,000 per qualifying individual. If you are married filing jointly and both you and your spouse are at least 65, that figure doubles to $12,000. This is not the same as the existing additional standard deduction that seniors already receive. This is a completely separate benefit layered on top of that. It did not exist prior to 2025. It was deliberately designed to lower the taxable portion of Social Security income for retired Americans. The full deduction is available to single filers with a modified adjusted gross income under $75,000 and to married couples filing jointly with income under $150,000. If your income falls above those levels, the deduction gradually phases out. If it falls below them, you receive the full benefit. This deduction applies to your 2025 return right now. It is claimed on the newly introduced Schedule 1A. But here's the part you absolutely need to hear. Not every tax preparation software program is automatically identifying and applying this deduction. It is entirely new. It was buried within an 1,100-page piece of legislation. Certain software platforms have not yet been updated to reflect it. Certain tax preparers have not yet gotten up to speed. You may need to actively look for it yourself. Ask your preparer point blank. Did you apply the senior bonus deduction from the One Big Beautiful Bill? If you get a blank look in response, you now know what that means. For a single filer in the 22% bracket, that $6,000 deduction translates into $1,120 in savings. For a married couple, the full $12,000 saves $2,140. When combined with the lump sum election, the total savings could land somewhere between $3,000 and $4,000, money that belongs to you. Now, some of you may have come across news that Congress has introduced legislation to address this issue at its root. The No Tax on Restored Benefits Act was put forward in February 2026. If passed, it would establish a one-time exclusion for the retroactive lump sum payments, meaning you would owe absolutely no tax on that money. The bill carries bipartisan backing and has been referred to the House Ways and Means Committee. As of today, April 2nd, 2026, it has not been passed. It is not currently the law. Do not sit and wait for it. Do not assume it will clear both chambers before your filing deadline arrives. If it does eventually pass, you can submit an amended return and recover whatever you overpaid. But if you let April 15th slip by, because you were counting on Congress to act and they do not, you will end up owing penalties and accrued interest on top of your original tax balance. File now, file accurately, submit an amendment later if the legislation changes. Here is your action checklist. 7 things you need to take care of right now. The first step is to locate your SSA 1099. If you received a Fairness Act lump sum payment during 2025, the full amount is documented on your SSA 1099 form. If you cannot find it, log into your My Social Security account at ssa.gov and download a copy. Take note of the total. That figure is at the center of your entire tax situation this year. The second step is to calculate your provisional income. Add together your adjusted gross income, any tax-exempt interest you earned, and half of your total Social Security benefits, including the lump sum. If the result exceeds $25,000 as a single filer or $32,000 as a married couple filing jointly, your benefits are being subjected to taxation. If it exceeds $34,000 for single filers or $44,000 for joint filers, up to 85% may be taxable. The third step is to run the lump sum election worksheet. Open IRS publication 913 and work through the lump sum election worksheet. Compare the outcome of Method 1 and Method 2 and apply whichever yields the lower tax bill. This step alone could save you $1,000 or more if the lump sum pushed your income past a critical threshold. The fourth step is to claim the $6,000 senior bonus deduction. If you are 65 or older and your modified adjusted gross income falls below $75,000 as a single filer or $150,000 as a joint filer, you qualify for this deduction. It is reported on the new Schedule 1A. Confirm it appears on your completed return. The fifth step, if you have already filed without applying these tools, is to submit an amended return using Form 1040-X. You have a 3-year window to do this. Do not leave that money sitting with the IRS when it belongs in your pocket. The 6th step is to check for IRMAA impact. If your 2025 income, counting the lump sum, pushed your modified adjusted gross income above $106,000 for single filers or $212,000 for joint filers, you may be facing Medicare premium surcharges beginning in 2027. You can appeal this outcome by submitting a life-changing event form, specifically Form SSA 44, directly to the Social Security Administration, provided you are able to demonstrate that the income spike was a one-time occurrence and not reflective of your ongoing financial situation. This process is not automatic. You must initiate it yourself. The 7th and final step is to prepare for the years ahead. The Fairness Act did not just deliver a one-time payment, it permanently raised your monthly Social Security benefit going forward. That increased monthly amount will factor into your provisional income calculation every single year from here on. If you were close to a threshold before, there is a real possibility you are now consistently above it. Speak with a tax advisor about strategies such as Roth conversions, qualified charitable distributions, or adjusting your tax withholding to prevent another unwelcome surprise next April. There is something I want to say directly. The Social Security Fairness Act was the right thing to do. Those benefits should never have been reduced or eliminated in the first place. But when Congress passed the fix, they did not account for the tax consequences. They were fully aware that retroactive lump sum payments would generate income spikes on paper. They understood those spikes would shove retirees into higher tax brackets. They even put forward a bill to correct it. That bill is still waiting in committee while 3.1 million retired Americans are submitting their tax returns. The IRS will not pick up the phone to guide you through this. Your tax software may not detect the issue. Your preparer may not be current on the details. That is precisely what this channel exists for. If you know a retired teacher, a firefighter, a police officer, or anyone who spent their career in public service and received a Social Security lump sum last year, share this video with them right away. 13 days. That is the window they have left, and the gap between filing correctly and filing on autopilot could mean more than $3,000. Leave a comment below. Did you receive a payment under the Fairness Act? Were you caught off guard by your tax bill this year? Share your story. I read every single comment, and the situations that come up most frequently become future videos.